Checking your investment portfolios this week might be less enjoyable than it has been in recent months, as we're currently seeing some of the most significant stock price declines we've encountered in a long time. The S&P 500 has dropped 6% over the past month from its recent highs, and the Nasdaq 100 is down 11%. So the question is the recent economic data indicating a downturn toward a soft landing, or are we heading for a recession? And here's why this question is relevant. Google searches for recession have reached their highest level in nearly 2 years. And the July 2024 jobs report revealed an increase in US unemployment. So, what's really going on? And do we need to take action? So, let me tell you what's happening. After a remarkable calm year, the stock market has recently experienced an increased volatility. And here's the reality: market pullbacks are a normal part of investing, right? We know this as an investor because we have the data over the past decades. So for you and me, it's crucial to focus on the facts rather than letting emotions take over. So let's examine the data. The last time the index fell by 2% was back in early 2023, which was 512 days ago. Here you see a graph of the S&P 500 with the intra-year declines from 1980 to 2023. An intra-year decline, which means a decline within that year, refers to a drop in the stock market or an index from its peak value within a given calendar year. It captures the fluctuations in the market that occur throughout the year, rather than focusing solely on the year-end performance. Historically, a 5% decline in a year is almost inevitable in most years. The S&P 500 has dropped 5% or more in 95% of the time during that period. And here's an interesting fact that many investors may not realize until they experience it. The average inter-year decline for the S&P 500 has been minus 14.2% since 1980. Additionally, we have observed intra-year declines in every one of the past 44 years. And despite these intra-year corrections, the market ended positively in 33 of those 44 years. In other words, the market has risen 75% of the time. And now here's the most important takeaway you've been waiting for. If you want to be a successful investor over the long run, it's crucial to stay invested despite the volatility. As noted, the market has experienced numerous intra-year declines with an average drop of about 14.2%. But if you stayed invested and stuck to your strategy enduring the volatility over all those years, that means you would even have to overcome a 49% drop in 1 year. And if you were able to endure all the volatility during those times, you will be rewarded as an investor for the risk, ending up with an average annual return of 9%. That's not bad, right? So if you find this information valuable, be sure to subscribe to our channel for future updates or share this valuable information with your fellow investors. So the stock market is supposed to fall every once in a while, right? Because it cannot just keep going up forever. So when you consider all the data, you might be asking, what's the point of the current 5% drop, right? The S&P 500 is still up nearly 13% this year. And yes, it was up as much as 20% at one point, but we are still looking at a double-digit total return in 2024 so far. And this is exactly the way you have to look at it. However, if you are seeing this data and it still makes your stomach turns at the thought of your portfolio potentially dropping at nearly 50% in 1 year, it's wise to consider adjusting your asset allocation. Adding more bonds to your portfolio can help balance out the risk that fits your personal situation. It's better to address this now rather than waiting until you face a 50% drop, right? So the key takeaway here is to manage your emotions. Don't let feelings drive your investment decisions. Instead, focus on the facts. Many individual investors underperform because they react emotionally to market movements. And this is why I really am a fan of the Stoic philosophy. Why? A fundamental principle of Stoicism is to concentrate on what you can control and accept what you cannot. We can control our thoughts, our actions, and our reactions, But we cannot control external events, other people's actions, the news, or the broader market. So, by focusing on what we can control and calmly accepting what we cannot, we can achieve greater peace and we are able to reach our goals. So, the best advice I have for you is this: stay away from the news and don't log into your portfolio too much, especially when you are getting nervous. The best thing you can do during downturns is buy more, and this is called dollar cost averaging. So when the market is down and prices are lower, your fixed investment amount buys more shares of the stock or mutual fund. Dollar cost averaging means investing a fixed amount of money at the regular intervals regardless of market conditions. So during downtimes, you buy more shares because prices are lower, right? And this approach spreads out your investments over time and helps lower the average cost per share. It works really well because it helps you avoid the stress of timing the market and benefits from buying more when prices are low. This can be really beneficial if the market recovers and prices go up again. So the best plan is by sticking to your investment plan, you avoid trying to time the market, which can be difficult. Instead of worrying about when to buy, you invest consistently regardless of market conditions. And as an investor, you will be rewarded for the risk you take. And remember, it's a marathon, not a sprint. But please don't take my word for it. Look at the data yourself and try to read some of the best books on investing you have. I will give you some great reads in the description. And the second best thing is, if you are the person who wants to be a successful investor, listen to the advice of an expert who have done a lot of good things in the positive for the average investor, an icon in the financial industry. In this video, he talks about the 10 most important things you cannot ignore. A must watch for every successful investor. So subscribe to our channel and see you in the next video with more important investment data.